Recessions are the norm in the economic game. However, while many lose everything, these are the moments when Warren Buffett sows the greatest results that he reaps. In this video, you will learn about the 5 steps he follows to protect and strengthen his wealth. Simple, practical strategies that also work here in Europe. But before we begin, remember to like the video and subscribe to the channel. In the last 15 years, we have witnessed this happen repeatedly. 2008, 2020, 2022. The market does not give warning when it will test the unprepared. And when it tests, it shows no mercy. Warren Buffett has never concerned himself with predicting the next crisis. He prefers something more reliable, to always be ready. His focus is not on the short term, but on fundamentals that stand the test of time. But what exactly does Buffett do when the market is shaky? How does he structure his portfolio to navigate turbulence without losing sleep and still grow? These are important questions, but the answer is not found in secret formulas. Rather, it lies in 5 clear fundamentals, tested over decades. The first step to navigating any crisis safely begins even before the crisis happens, in the choice of companies in which you invest, and this starts with the fundamentals. Buffett has always made it clear that the risk is not in the market, but in not knowing what you are doing. Therefore, look at these 3 key indicators when investing in a stock. The first fundamental is the free cash flow of the company. This metric shows how much money a company has net in cash. It is the money that will be used to face unexpected events and seize opportunities. Imagine a company that has 10 billion euro in cash, generates 2 billion euro a year, and has 3 billion euro in short-term debt. Even if its revenue drops to zero, it can pay off all debts and still have 7 billion euro left. This company not only survives in tough times, it can even grow while others are struggling to keep the doors open. The second fundamental is the competitive advantage that Buffett so highly values. These are companies protected by a kind of economic moat which prevents competitors from threatening their market position. This can come from an extremely strong brand, proprietary technology, or a scale that no competitor can match. The clearest metric here is the return on invested capital, the ROIC. When this ratio is maintained above 12% for several years, it is a sign that capital is being allocated very efficiently. And even in tough times when margins tend to fall, it will still be profitable. However, efficiency without sustainable profit does not keep any company afloat. This is why the third fundamental is a stable and high operating margin. Above 15% is a good starting point. This indicates that the company can convert revenue into real profit without relying on accounting tricks or aggressive cuts. And this is just the first step. Keep watching, because this could completely change your way of investing. Consider the following. During the 2008 crisis, Coca-Cola fell by 33%, but in just 2 years, it had already recovered all its value. Why? Because it continued selling, generating cash, and maintaining strong margins even with the world in recession. And here's a challenge. What is the real chance of giants like Alphabet or Apple going bankrupt in the next decade? They have billions of euro in cash, solid margins, and a competitive advantage that no startup can replicate overnight. Companies with solid fundamentals are not invincible, but they are much more predictable in recovery. And this completely changes the game when the market begins to fluctuate. Even when choosing the best companies, there is always a risk that you cannot control. It could be a regulatory change, a technological disruption, or simply an internal scandal. This is exactly where the second pillar of the survival strategy comes into play. Diversification. It serves to reduce the impact of isolated events that, no matter how unexpected, cannot compromise your entire portfolio. It functions like a cushioning system. When one asset declines, others may remain stable, or even appreciate. For it to truly work, it is necessary to diversify across 3 different dimensions. The first is sectoral diversification. Avoid concentrating all your investments in a single segment of the economy. Sectors do not all move in the same direction, and it is precisely this lack of correlation that protects your wealth. The second dimension is the type of asset. Stocks can offer long-term growth, but they are more volatile. In contrast, sovereign fixed income securities tend to behave more steadily. The balance between asset classes is what prevents your entire portfolio from plummeting at once. Lastly, there is geographical diversification. Many investors concentrate everything in assets from their own country. However, the ideal is to combine exposures to the Eurozone, the US dollar, and even emerging economies. Buffett often says that concentration is for those who know exactly what they are doing. For the average investor, diversifying is a defense against one's own ignorance. We do not work with investments. We simply want to see the fruit of our labor working for us so that we can enjoy more. There is nothing wrong with that. In this case, diversification is like building a bridge with multiple columns. If one fails, the others support the structure. But now if there is anything that no crisis can take away from you, it is your ability to generate income based on what you know how to do. Buffett is straightforward about this. Invest in yourself. No one can take that away from you. The third step is this: to develop valuable skills. This is even more important for those aged between 35 and 60 with technical baggage and accumulated professional maturity. Your skill is your number one asset. It is liquid, scalable, and highly protected against inflation, taxation, or market instability. A valuable skill is one that continues to be in demand even during cost-cutting periods. And more than that, it is scarce. Few people master it deeply. This creates a favorable asymmetry. The market pays well because there is not enough supply. But how can you tell if you have one of these? Start by taking inventory of your current competencies. In which areas do you already have practical experience? Then, see what could be leveraged with just 20 or 30 hours of targeted study. There are especially promising areas: strategic consulting for small and medium-sized enterprises, logistics, IT, among various others. These functions are transversal, well paid, and valued across different sectors. When you pair a diversified portfolio with a personal asset that continues to generate income even when the market is falling, it places you in a secure position even amidst a crisis. Many investors focus so much on profitability that they forget what truly determines who survives a crisis: cash. Buffett does not maintain liquidity by chance. For him, cash is a silent pillar of strategy. It allows one to act when everyone else is paralyzed. Having cash means not being forced to sell shares at the worst moment. It prevents emotional decisions from destroying years of wealth accumulation. But it is also what puts you at the front line when the best assets become available at a discount. Do you want a real example of how this makes a difference? During the crisis of 2020, Investor A did not have a solid reserve. He panicked, sold everything at a 35% loss, and missed out on the recovery that came in 2021 and 2022. On the other hand, Investor B had cash. He maintained his positions, trusting in the fundamentals. 2 years later, his portfolio was 28% above its initial value. Investor C, on the other hand, went further. With cash available, he bought quality shares at a low price and saw his portfolio appreciate by 52% in the same period. Which of these profiles do you want to be in the next crisis? If you're a salaried individual, saving at least 3 months of fixed expenses already makes a significant difference. For self-employed individuals or business owners, the recommended minimum is 12 months. This money should be kept in accounts with daily liquidity and protection of up to €100,000, such as Trade Republic or Scalable Capital. Many treat cash as idle money, but it is in fact the most strategic capital there is. It is with it that you act intelligently when others are afraid. And in the final step, you will understand why none of these strategies work if you do not do what I'm about to say now. What separates a consistent investor from someone who has just had luck for a period of time is patience. No strategy works if you cannot see it through to the end. When markets decline, many abandon their plans. However, the investor who remains steadfast, relying on data rather than emotion, tends to emerge stronger on the other side. And how does one maintain this patience, especially when everything around you shouts for you to exit? The first thing is to have clarity. Do the reasons that led you to purchase a stock still hold? Has the company changed, or has only the price fallen? Being able to answer this is like having a map amidst the fog. The second step is to shield your mind against emotional pollution. Reduce the number of times you check your portfolio. And, most importantly, document each purchasing decision along with the reasoning behind it. This record becomes an anchor when everything seems uncertain. The truth is that you do not need to predict the bottom of the trough. You just need to be prepared and confident not to exit before the recovery begins. If this content has made sense to you, subscribe now to receive more rational strategies to protect and grow your wealth. And remember, Buffett built his fortune with method, not haste. See you in the next video.